Good evening, everybody. Thank you very much for joining in. This is 86th in the series where we're going to speak about one of the very exclusive topic in the world of foreign exchange and especially in the world of non-deliverable forward market, which is non-deliverable liquidity swap. Today we are going to cover the non-deliverable liquidity swap from exporter's point of view. Well, from this side, I am Rahul Magan, working as a corporate treasurer for EXL, which is an American company. Well, today we're going to have a word about one of the very fantastic topic in the world of foreign exchange, which is non-deliverable liquidity swap. First of all, we need to understand, because this topic, non-deliverable liquidity swap, we are dividing into three parts. So this is first part of the series, which is part A, and this part of the series would fully devote about what do you mean by liquidity swap and what do you mean by non-deliverable market. First, we need to understand that worldwide foreign exchange market, which is FX market, shortly refers to it, divided into two parts. One is deliverable and another is non-deliverable market. Now, deliverable market sometimes refers to as onshore markets also. Onshore markets refer to those markets where exactly you are. So take a very simple example. For American companies, America is an offshore market. For onshore market. For Singaporean companies, Singapore is an onshore market. For British companies, British markets is an onshore markets. Whereas all markets are divided as non-deliverable market or sometimes also known as offshore treasury markets. You must have heard about a term which is known as onshore-offshore spread. The onshore-offshore spreads coming from here. Example, the premium which is trading at New York market versus the premium trading in the offshore market. Predominantly, there are 5 or 6 offshore markets we have worldwide. Predominantly, you have Singapore, you have New York, you have London, you have Frankfurt, you have Luxembourg, you have Dubai, you have Shanghai, you have Philippines. So these are the few important offshore markets you are having. Now these offshore markets will deal in an instrument which is known as non-deliverable instrument. Now in shortly I am writing non-deliverable instrument. Non-deliverable instruments could be your forwards, could be your options, could be your OIS, overnight index, swaps, could be your swaps, could be your interest rate derivatives, and other exotics. Well, this topic will predominantly speak about a currency which is USD INR. And in USD INR, we are going to target what do you mean by the aspect of non-deliverable. Now take a very simple example. Hereby we are assuming a company which is Cognizant. Now Cognizant, a company which is an American company, and this company is giving outsourcing services across the world. And as of now, this company would have a top line of close to $13.5 billion across the globe. We all understand that Cognizant, Sapient, Accenture, Microsoft, Google, Genpact, WNS, these all companies are performing on a transfer pricing model. So exactly what do you mean by transfer pricing? These companies, basically the American parent of these companies would act as a marketing agent. They are getting the business from their networking or from their marketing relationships, and they're transferring these business to offshore locations. Now, who are these offshore locations where they are transferring the business? Predominantly, we can understand that as of now, there are two important offshore locations, which is either India or Philippines. Now, since India is doing a work, so here we are referring Cognizant India or Cognizant Philippines. In short, I'll write Cog India and I will write Cog Philippines. Now Cognizant India and Cognizant Philippines would do a work for their American parent. However, of course, if you are doing a work, some cost would be there. Now what would be that cost? Your operating cost, your salary cost, your vendor cost, your facility cost, your capital expenditure cost, and various other kind of costs. These costs are going to be reimbursed by their parent, and this is known as transfer pricing cost plus method. Now what is going to be? There is going to be some cost and there is going to be some margin. Now this margin is known as markup. That is going to be charged by Cognizant India to Cognizant US. Now assuming every month Cognizant India is doing a billing of $10 million per month to their parent, which is Cognizant US, and in return Cognizant US is reimbursing them. Now this is foreign currency AR in the books of Cognizant India and foreign and dollar AP in the books of Cognizant US. Now for Cognizant US it doesn't matter because books are in dollar and AP is in dollar, so there is no impact of revaluation in the books of Cognizant US. Now what do you mean by revaluation? Revaluation refers to a fact when you convert the foreign currency into local currency. So for Cognizant US it's not going to have any impact, but the impact would certainly be for Cognizant India, because here the functional currency is in INR, however AR is in dollar. Every month you are going to close the books, and when you are going to close the books you would have some amount of revaluation impact. Now take a very simple example. October 2015 the INR was closed roughly 65.47 and November 2015 INR was closed at 66.70. So you would have roughly INR positive revaluation for 1 rupee 20 paisa for exporters. That revaluation impact is going to hit your books. Now to hedge this revaluation impact you would have two options. One, you can hedge this revaluation in India using a concept called cancellation swap. So you will book a contract, you will cancel it, you will rebook it. You will book the contract, you will cancel it, you will rebook it. This is cancellation swap. Another way to book this contract in your books is a non-deliverable forward contract. Please be note that non-deliverable forward is not a market. Non-deliverable forward is a concept. So basically market is a non-deliverable, but we always refer to as a non-deliverable forward. It's a misnomer in Indian. It is basically a non-deliverable market. Assuming Cognizant is dealing with a non-deliverable concept. So they would take non-deliverable forward with some Singaporean based bank. Assuming they are taking up with Singapore. Now here we are assuming Cognizant would take contract, say JP Morgan Singapore. Now in non-deliverable forward contract there is no swap, there is no spot rate. It is going to be done, the spot is going to be your RBI fixing. Of course in non-deliverable sometimes you will deal in spot, that is known as all-in rate market, non-deliverable all-in rate, that we are going to discuss later. In fact this is a very new topic, non-deliverable all-in rate. But for pertaining to this, you would have something which is non-deliverable fixing. Now what is fixing? RBI every day would fix four currencies: USD INR, Euro INR, GBP INR and JPY INR. If you carefully see, these four currencies are also a part of your futures. Now here we are taking an example of USD INR. When RBI deals with fixed USD INR, now assuming today is 30th November. Now today is 30th November and 30th November 15 Cognizant India will sell, assuming every month you are billing $10 million and out of this $10 million you are getting some money which is always less, and cumulatively we assume that there is an exposure of $250 million, or take it $350 million. Now what is that exposure? This is foreign currency AR in the books of Cognizant India, and this is foreign currency AP in the books of Cognizant US. For US it doesn't matter because the cost and AP is in the same currency. Now what does matter? Cognizant would sell 250 million AR to JP Morgan Singapore, and the fixing would happen like that. It would be USD INR fix plus premium. So assuming USD INR fix for 30th November is 66 and 1 month premium, because they are selling 30th November to 30th December. 30th November to 31st December. So assuming 66 is the fixing and the premium is 1 rupee, so total would be 61 rupee. That 61 rupee would be the rate at which Cognizant sold their AR, which is $250 million to a Singaporean bank, which is JP Morgan Singapore. This is all about non-deliverable forward. How to settle it, we'll talk later. But please be note that in this entire, whatsoever we discuss, this is the most obsolete way of doing non-deliverable forward contract. The rationale is very clear. You cannot do a transaction even one day before the fixing rate. So you have to do a transaction on the last working day of the month. Suppose you miss out the transaction and you are gone, because fixing has already been done. You will never get a premium on time, or you will get a less premium. Suppose you want to take the benefit of INR exchange rate, onshore offshore spread. You cannot take the benefit because you have to do this on the last day of the month. So basically the arbitrage kind of situation is fully missing. To replace this obsolete structure, we have one swap which is known as non-deliverable forward liquidity swap. Of course, we're going to speak from an exporter point of view in this. This is all about the part 1 of the series, where we are going to work about non-deliverable, basically the most obsolete way how to book a non-deliverable swap. Let me give you a small recap. We've taken an example of Cognizant, which is an American company with a top line of $13.5 billion. We understand that Cognizant US is transferring the business to offshore locations, which is India and Philippines, and they are the one who are doing the business for their American parent. We also understand that at the end of every month, they are doing a billing of $10 million to their parent, which is Cognizant US. Now, assuming that over the period, this turned out to be $250 million, which is the cumulative exposure. Now, non-deliverable forward, you are hedging in an offshore treasury market. The worldwide, you are having 6 offshore treasury market, which is Singapore, New York, London, Frankfurt, Dubai, Shanghai, Philippines. Now, these offshore markets, now assuming you are hedging the most liquid, which is Singapore. Now, this Singapore market you hedged RBI fixing +1, which is 61. Now, you're going to settle this 61 after a period of time. You're going to settle this 61 after next month, when the next month fixing would come. Now, this is the most obsolete way. Most obsolete way in the sense like you have to deal on the last day. You cannot deal even one day before. You cannot take the benefit of the onshore offshore spread, and you cannot take the arbitrage position in the game. This is all about the part 1 of the non-deliverable exporters liquidity swap. You're most welcome to give me a call at 9899242978. You are always welcome to email me at rahulmagan8@gmail.com. Immediately after next, we are coming up with part 2, where we are going to start with how to initiate the same transaction using non-deliverable liquidity swap, but bear in mind that these all what we discussed remains intact. Thank you for your time.